听见资本本期视频为您带来的是摩根大通在3月27日录制的关于全球各经济体通胀分化加剧话题的内容。通胀的阴影笼罩全球，2025年初的经济复苏正面临严峻考验。这次对话深入剖析了2月份的全球通胀监测数据，揭示了粘性通胀的持续威胁以及关税政策带来的额外压力。你知道这对你的钱包和未来意味着什么吗？核心通胀依然坚挺，2月份虽比1月稍有缓和，但年化率仍超 3%， 远高于舒适区。商品通胀回升至 1% 左右，关税还未全面发力就已经这样。若更多政策落地，价格上涨可能直逼 5%， 直接吞噬你的购买力。服务通胀也好不到哪去，年初波动后依然强劲，靠着服务业活动硬撑，但随着关税拖累全球需求，这支撑还能挺多久？全球通胀还呈现分化，美国压力山大，核心通胀可能冲向 5%， 美联储想宽松都难，而欧元区通胀下滑更快。新兴市场如印尼、马来西亚和中国低通胀占优，但墨西哥、加拿大却因关税和增长双重打击，衰退风险加剧。别以为这跟你无关，关税引发的供给冲击可能短期推高物价，中期却因经济放缓让你荷包更紧。能源和食品价格也在添乱，年初油价反弹已拉高总体通胀，幸好2月有所回落，但波动性让你我都捏把汗。Bruce 和 Nora 警告，这场通胀博弈不仅暴露经济复苏的脆弱，还可能让央行政策左右为难。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome to Global Data Pod, Global Inflation Monitor for the month of February 2025. I'm Bruce Kasman, and with me is Nora Centivani, who will talk about her inflation monitor, which has been really interesting recently and is really interesting in the month of February. So Nora, let me just frame this by saying we come into the year thinking sticky inflation was going to continue to be the theme around potentially more divergence in the country and regional breakdown. So in addition to taking a quick victory lap on that, because that seems to be broadly what's happening, give us a sense of how you're seeing the landscape in February. Obviously, we're going to have to get into how much, if at all, of this has any tariff impact and where we're heading. But let's just start by doing the basics on how you read what the news is for the month of February.
Yeah, Bruce, thanks. So just starting with January, we had a broad-based upside surprise, just to remind our listeners. And I guess there was some concerns coming into February that we would get a continued, very strong upward pressure at the start of the year, continuing after the upside in January. I think there's a little bit of relief in February that the monthly core CPI gain moderated a little bit to 0.25 month on month from a 0.35 in January. So it was a tenth softer than in January. But that doesn't really change the overall picture of, still what looks like very sticky core inflation at this point.
In context, 0.25 is running at over a 3% annualized rate a little bit, right? So that's still a sticky outcome. It didn't persist with a high January, but didn't reverse it either.
Correct. So it doesn't change that overall picture. The 3-month annualized run rate is still at 3.3, so that's unchanged from January. And I think if we kind of go back 2 months ago, you and I wrote a piece called The Testing Time for Core Inflation before any 2025 CPI data had come out, and we made several calls there, and one of them was that core inflation would kind of stay sticky around the 3% mark. I think relative to that, if anything, we've been surprised to the upside. As I mentioned, we're running at 3.3. In the piece 2 months ago, we were forecasting 3, so we're, 3/10 higher. And we had nudged our forecast for the first quarter higher as well to 3.4. So, I think certainly relative to 2 months ago, we're tracking stronger on core inflation, and firmer readings are looking, quite broad-based here. In terms of the drivers of the upside, so the other kind of strong call we made back in January was that core goods inflation would firm to a roughly 1% pace. And that was coming off fairly soft core goods inflation readings in 2024. The second half of last year had been tracking at a 0.5. And we made the call that even before any tariffs came into effect, core goods inflation would be picking up at the start of the year to about a 1% pace. And, lo and behold, if you exclude U.S. autos, where we've seen a very strong surge, we are in fact tracking that sort of 1% pick up to that 1% pace. If you include U.S. autos, core goods inflation has actually picked up to a 1.8% pace. So things there are looking, I would say, firmer than we anticipated.
There, and kind of just ask, in terms of the things we thought would be driving that, we had a view that there were some cost pressures that were brewing in the system. We had a view that global manufacturing picking up would create some firming in pricing power. We had a view that that would generate breadth in that space. I think that's important as well, even counting for the auto pricing story in the U.S. So I guess the question is, you track what we actually have had happen, and the surprise that's been to the upside for the first couple of months of the year. Is there anything that's kind of changing our thinking about drivers here? And let's leave the forward-looking side on tariffs for a second. We'll obviously get into that.
So I would say on the core goods side, it's shaping up to be a touch firmer than we anticipated. So there's even more of a pickup. And as I said, this is before any real tariffs even came into place. So there's a sense that there's some anticipatory impulses ahead of tariffs. Of course, by February, we had already the 10% tariff hike on China, but not much else, right? The other tariffs on Mexico, Canada, steel and aluminum, those came in March. But they were already, the surveys were already telling us that there's some anticipatory impulses here, putting upward pressure on core goods prices. And I would say it's quite broad-based, right? So I think, 2 months ago, we were saying, okay, a lot of this is U.S. autos. We're not really seeing that much firming elsewhere. But come February data to hand now, I would say it's fairly broad-based pressure across countries and within the U.S. as well. It looks more broad-based. It's not just autos. It's a broader set of goods. What we can see is in the import price data, consumer goods ex autos were up quite strong, 0.4 in the U.S. For the month of February. Import prices from China rose as well. And remember, these don't have the tariff hikes in them, right? So these are kind of reported ex tariff. So one would expect that we will get a further firming.
We're running 1.8 with a 1% ex autos. That's kind of where we thought the peak would be. We now have more tariffs embedded in our forecast. How much upside do you think we might have here over the next 3 to 6 months on core goods pricing? And let's just kind of recognize the point you made a second ago, because I think it is important, is that the pressures we've seen in the first 2 months of the year are not that concentrated. They're fairly broad. So how much more do you think this thing can run?
Yeah, I mean, I think it, it can run further. Next week, we're probably going to get a broader set of tariffs announced, not just on China, Mexico, Canada, but across a wider set of countries, wider set of sectors and products. So I think once those are in place, you would expect to see additional upward pressure here. So I think, it seems quite likely that in the next sort of 3 to 6 months, we will get more pressure.
Are you down? Let's say the norm before the pandemic on core goods was like 0.5% or so, roughly globally. The period between 21 and early 23, we ran something closer to 6 globally. Where would you kind of put a reasonable range for the next 6 months, let's say, in terms of what we run on core goods?
Yeah, so I'm just going to take the U.S. auto stuff out of it to get a clearer trend of where we are now. So now, as I mentioned, we're running around this 1.1% pace. That could get up to 2, I would think. Okay,
so 2 compared to where we were in 24, where we ran a touch above 3%, would probably be adding 3 or 4 tenths to core inflation. So our starting point for a conversation on services is to keep inflation level, you need a good step down in service price inflation, right? Is that the right way to think about this?
Yes, exactly. You would need core service price inflation to moderate a fair bit for us to kind of just to keep core inflation close to 3. I mean, if that doesn't happen, then core inflation here will be like 3.5 plus will be the new norm.
And we're not gonna get into the issue, which is obviously a big macro one, which is if we see these core goods price pressures and they are influenced by tariffs, to what degree are they transitory, as Chair Powell resurrected that word. But let's leave that for a moment. Let's just sort of stay in the first half space in terms of the service price story. So we had expected some noise in terms of early year service price inflation. And we did get a surprise in January to the upside. So when you kind of look at the service prices and you see Jan up, February off somewhat, but not low, how much in terms of the first 2 months of the year do you think that's noise versus signal in terms of stickiness and potential upside on that front of the story?
Yeah, so this early year price resetting, I think we had made the call 2 months ago that it would likely be there, but it would be somewhat less than we had seen this time last year and the year before. And that seems to be what we're getting. So, we had a 0.4 increase in Jan, 0.3 in February. If you average those, that's about 1/10 less than what we had in early 2024 and 2023. So on a year ago basis, services inflation is down a tick, down 1/10. But, the 3-month run rate is still very strong at 3.8. And that really hasn't made much of a move lower since like September last year. So I would say the way I would characterize it is still very much consistent with a stall in services disinflation at this point. I think for me, a key question will be what happens with services activity, right? Because we had been highlighting that strong services activity would continue to underpin strength in services inflation. Is that going to be coming off now with tariffs and potentially some downside risk to growth?
And certainly what we saw this week in terms of the flash PMIs is the future output in services, whereas the actual output one actually got a boost as the U.S. rebounded from a low January, but the future output numbers went down pretty much across the board in services, which is, a little bit harder to explain off of the macro story on tariffs and some other things. So that's certainly in the picture. But let me kind of turn to another point, which is as you said, we had been looking for some pickup with some front loading, but we've also been arguing that macro fundamentals are divergent and that they would drive reasonably big divides in terms of inflation trajectory this year, with services being the key force behind that. What are you seeing there across countries and regions? Is there any signal about whether that view is tracking? Where are we being challenged? What's the call from your processing in the first 2 months of data?
Yeah, so we are getting some country level differentiation, and it is broadly in line with what we had anticipated, which was that, we were looking for euro area inflation to slide more than the US. First 2 months are certainly tracking that view. And for EM, we said that on a kind of cross-regional basis, cross-country, would stay quite differentiated. In terms of the run rates for services inflation, really the US on the CPI basis has surprised us significantly to the upside relative to where we thought things would be 2 months ago. Probably a full 1% higher than what we were expecting. A lot of that is due to the January strength, which then didn't fully, as you said, reverse in February.
Although we should note that we're talking CPI, and if we're right, the PCI is going to have the PCE is going to have the reverse pattern of a lower January and a firmer Feb. So
correct. I think the message there is that earlier large wedge between the two seems to be closing, at least on the 3-month run rates, with the core PC ticking higher and the CPI cooling a bit into February. I mean, I guess what we had been saying for the US as well is worth adding, that there are some encouraging signs, right, coming from the more inertial rent of shelter measure cooling off somewhat. But as I mentioned, the core goods side is relatively broad-based strength, and tariffs will add to the upside. So, but yeah, just coming back on the services for Euro area, we are actually tracking a touch lower than where we thought we would be 2 months ago. So we're on track for, getting down to about a 2.5% pace by next month. And then the UK had a very large downside surprise on core goods. For overall core, as a result of that, we seem to be tracking also a little bit lower than we thought. But
area versus US is a DM kind of dynamic in terms of the inflation profile. Where you talked about differentiation in EM, where do you see the biggest sort of shifts in trajectory in a relative sense?
Yeah, so I mean, there's been a lot of volatility, as you can imagine, in the last few months. So it's a little bit difficult to extract a clear signal. But if I look through the noise, I would say it's still kind of the same group of countries that are showing a softening inflation trend or low inflation, which really is much of EM Asia, Indonesia, Malaysia, China. South Africa is in that camp as well, where services inflation has moderated to below pre-pandemic averages. But then for the majority of countries, things are looking still quite elevated. Again, I would highlight within that Colombia, Brazil, Hungary, Romania, so much of EM Europe outside of Czechia, things are looking still quite firm on the services inflation side. Yeah, so it's a fair amount of differentiation there. I think one thing we should probably highlight is that even though February showed some moderation in services inflation, there's of course still April, which tends to be another month where there's a lot of price resetting, especially for countries which start their fiscal years like the UK, like Japan. And, that price resetting is expected to be stronger in both places, right? In the UK, you've got the employer's national insurance tax hike, which might get passed on to consumers. Japan, you've got surging input costs with wage growth being very strong. Again, that could be passed on to consumers. So the expectation is that in quite a few countries, you could get further renewed upward pressure come April. So I think we're not out of the woods yet, but I'm feeling generally comfortable, Bruce, with the idea that especially if services activity decelerates or moderates here, services inflation will make a gradual move lower, but I just don't think it's going to be quick enough or large enough to offset this upward pressure in core goods that we're going to get, especially if you put tariffs on top of it.
So if I'm hearing you right, we've started the year a little firmer than we expected. We've got reasons to expect core goods pricing to continue to be firm, but it's probably on that basis alone not going to shake us from the view that the primary message about inflation is stickiness with differentiation. Now we get into the tariff story, and let's assume for a moment we're not breaking the global economy. Obviously, that changes everything in terms of the way we'll think about the inflation outlook. My natural tendency is to just say the simple point here is that the U.S. is going to feel the brunt of this on inflation. Everywhere else, it's going to be more marginal. So in terms of your, kind of broader view, the one thing that's really a threat here is that U.S. inflation prints a lot higher. A, is that reasonable? And B, is there some pockets in the world that we should be focused on that could prove different than that, that general view would suggest?
I think that's fair. U.S. is really where we should see the brunt of it, and like all the surveys, all the signs are there that we get further upward pressure. I think there were some arguments earlier that the U.S. tariff hikes could convince foreign suppliers to reduce their prices to retain market share. We're not really seeing much evidence of that happen. So it very much feels like these tariffs are going to be largely passed on to you.
If they just put it in context, if we're running probably, let's just say 3-ish on underlying inflation right now in the U.S., and we're adding, let's just say for argument's sake, about 1% of the level of prices over the next 12 months, but it could be concentrated in the front end of that period, then we could be talking about a 6-month run of U.S. core inflation running closer to 5. That's kind of the numbers that, would be consistent with that view. So that's a different environment, even recognizing that everybody should look at that as to some degree a one-off set of pressures that is not going to persist. But that's still a big move, especially if it's going to be in the picture for more than a couple of months. It could be in the picture for 3 to 6 months. So, anywhere else in the world that you worry that we might see some pressures kind of build on the tariff story?
I would say for the other countries, we're going to get retaliatory tariffs most likely, but it just doesn't look like the overall effect is going to be as large, right? Because effectively those countries are just retaliating on trade with the US. And if you take a country like the euro area, then that trade as a share of their GDP is not that large, right? So you wouldn't expect those tariff hikes to be having a very large impact on inflation. I think we also need to bear in mind that there's going to be there is already a hit to sentiment and growth, most likely in a number of places like, Mexico, Canada, even to a modest extent in the euro area. And, I think in places where the growth hit is large, and that would be, again, Mexico, Canada, much of EM Asia, if we get these sectoral tariffs coming into play, you would expect the weakening in sentiment and demand to put downward pressure on prices more than anything else. So Mexico is a good example where we think the economy is already in recession, and we're actually starting to see already a moderation in services inflation. And I think that can continue. So also the survey measures for pricing have moved up a lot in the US, but not so much elsewhere. So in the euro area, we're pretty much unchanged at kind of long-term historical norms in terms of what the surveys are telling us on pricing, whereas in the US, we've moved almost 1 standard deviation above. But that upward pressure is not that evident in other countries. And I think the weakening in demand and growth as a result of tariffs for countries that are highly exposed to the US will offset some of the upward pressure coming from, retaliation.
So let me just sort of close this. Let's stay away from what we kind of recognize as elevated concern that something could break in the U.S. We've been talking about a 40% probability of recession, not for the taking hold in the next few months, but perhaps later this year if things go more badly wrong. But let's leave that scenario out because we know what that scenario is going to deliver on inflation. It's going to deliver broad-based unwinds and disinflation across the world. But if we stay in broadly our baseline forecast on growth and we run the tariff story through the system, and we assume, for example, that the U.S. pressure will leave the Fed with little room, if any, to move. Is there a place in the world where you feel like we should be focused on here in terms of where central bank behavior is going to turn out differently than either our own forecast or the market is currently pricing?
Well, I don't know about those cuts in the U.S., whether they're going to get delivered, right? So the bias there would be, who knows? If growth continues to run strong and you got inflation near this 4 or 5% range, if that happens, then that won't leave them much space. I think elsewhere, I would say it's more to the downside, Bruce, because of, for the reasons I already mentioned. I think in EM Asia, and that's really a region where, apart from China, we really haven't seen the tariffs hit yet, but I think they're coming, and there's a lot of countries there that are highly exposed, whether it's a Thailand, a Malaysia, Vietnam, Korea. I think those countries, especially once this early year lift linked to front loading ahead of tariffs fades, you could get a situation where growth is really softening quite substantially, and they're very exposed to, a broad
The only
range
thing
of
about those countries is those are also countries with already pretty low policy rates for the most part.
No, but remember, they didn't really participate that much in the easing cycle we've had in the rest of in LATAM and CE in the past year, or there's been very limited participation. It only really got started a couple of months back. So I think there's still space there. And then, I mean, euro area is an obvious one, although there's now some obviously support coming from the fiscal stimulus that is an offset. But nonetheless, I think with inflation coming off, if anything, a touch more than we had anticipated, I think there's still space there to cut. Mexico, Canada, obviously, will need to respond to recession risks and the downshift in growth. You know, even places like Brazil, right? We could be seeing an end of that tightening cycle at some point. Rest of Europe is where I don't have a very high conviction because there's these sort of crosswinds, right? From the fiscal stimulus and the recovery in euro area growth coming against or going against the impact of tariffs. So it's a little bit more of a mixed picture.
So let me maybe end this by asking you a tough question, which is, around our baseline forecast, which is that inflation basically stays close to 3% over the course of this year. If we're going to be 0.5% or more off on that, and I'm not going to ask you to kind of condition it on a particular outcome on growth or tariffs. If we're going to be more than 0.5% off on that, which direction are you biased?
Oh, on core inflation, I would say for the next 2 quarters up. And then for 2026, it could be more down, right? So it's very much near term up, and then more medium term, it's kind of less obvious. But yeah, near term, I would say there's upside, further upside. Just, you know, largely, Bruce, because we haven't really built in a lot of the tariffs into our forecast, right? What we have built in so far is really just what's been implemented through.
So then if you had to say relative to our forecast, our global central bank call, is it biased towards less or more easing? I mean, I would obviously assume less given what you just said, but is that right?
I mean, for the US, I would say less. And then for the others, I think it's a bit more mixed, right?
Well, you didn't break out the inflation forecast by the U.S. and everybody else. I'm assuming some of your upside risk on inflation is concentrated in the U.S. So
it's a supply shock, right, Bruce? I mean, it hurts growth, so it's not an obvious answer to that part of the question.
Obvious answer. I wouldn't have asked it. That's, I think, part of the points to put you under a little pressure here. Anything else you want to end with that we haven't talked about yet? We haven't talked about energy.
Food and energy. I mean, just a quick one there, really, before we wrap things up. You know, we correctly made the call that a rebound in oil prices around the turn of the year and into the start of the year would push headline inflation sharply higher, which it has done. So 3-month annualized rate on headline inflation globally is up at 3.8, and that's up quite sharply from about a 2.6% pace it had been running in the prior 6 months. That is taking some steam out of consumer spending this quarter after a very strong 4Q. I think going forward, the sense is that energy prices are broadly stabilizing. We had a fairly strong increase in natural gas and electricity prices, but in Europe, for example, TTF has come off in the last couple of months, and we've reversed at least half of the increase we had in the second half of last year. So it does feel like, even if Brent crude rebounds a little bit here, as Natasha and team are looking for, I think you would get a bit of offset, at least in Europe, from the gas prices coming off of late. So yeah, energy price inflation, I think, has peaked. So in January, we had a peak of 16% annualized. That's down to about 13 in February. And I think that can probably moderate into the low single digits over the next couple of months.
Okay.
Yeah. So that early year upward pressure is fading. And then on food prices, things are really easing off at the start of the year after upward pressure. In a number of EM heavyweights, we had very adverse weather conditions, but all those food price pressures are now coming off, and we're back to the kind of pre-pandemic norm, 3% food inflation.
Okay, I think we'll end it there. lot of food for thought there, and plenty to continue to talk about. Guess we'll pick it up again next month as we look at the March inflation monitor. Take
Thanks.
care, everybody.
This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025 JP Morgan Chase & Company, all rights reserved. This episode was recorded on March 26, 2025.